Reporting season was okay. There were quite a few specific themes that came through in the reporting season. Firstly, there was mining services stocks have clearly come back into favour, and we've started to see a lot of those companies significantly deleverage their balance sheet. So companies like Ausdrill and Imdex performed quite strongly throughout the reporting season. Consumer stocks were quite mixed. You had good performances from JB Hi-Fi, Harvey Norman, Nick Scali. The other end of the spectrum, specialty fashion struggled through that period, and a lot of them cited another theme being that the election period really put a lot of spend and brought the economy to a halt. Seven West Media called that out in their outlook statement, said that things were tough throughout that April, May and June period where we had that longer election cycle than usual. So it was a bit of a mixed reporting season. Earnings per share estimates have come down very, very slightly into FY17 and into FY18, but generally our outlook statements were very guarded. Companies were quite cautious about what they said on the outlook, so we'll bring, once again, AGM season will be critical. I think generally high PE stocks underperformed low PE stocks, about 2 to 1. So companies like REA that were priced quite well, pre-results disappointed on the outlook statement there with the cost growth coming into the business over the next 12 months, and companies like Southern Cross Media, which were almost on a single-digit PE in the months in the lead up to the result, performed quite strongly on the back of a good result and a strong outlook statement and a low PE. So that was another key theme that we started to see come through the market over the last month. Credit Corp was one that exceeded expectations and exceeded our expectations on the result, and also the outlook statement to us still looks quite light based on what our numbers are we're forecasting here at WAM. The result was quite strong, driven by the higher purchasing activity they've done in the market over the last 12 to 18 months with the PDLs, and also the competitive environment for Credit Corp is as good as we've seen it in the last decade, with companies like Collection House reducing their activity levels in the market, foreign players struggling to gain traction, and also NCML, which is an owned company owned by Thorn Group, certainly winding back their operations as well. So generally the key for Credit Corp is the competitive environment is very, very favourable for them at the moment, and they're taking advantage of that. Look, it still looks quite cheap to us on a PE of 14. We forecast it can grow at north of 20% into FY17, so we believe that the level of purchasing activity that they've undergone in the last 12 to 18 months will start to flow through in their earnings in the next year or so, and we think that could really drive consensus and earnings upgrades over the next 12 months.